Most people spend years planning how they'll retire, but almost no one spends enough time planning when they'll retire. They wait for the annual bonus, the perfect farewell, or until one last project is finished. It feels like the right decision. But here's what many retirees discover too late. The month you retire doesn't just decide when your paycheck stops. It quietly determines how much money you'll keep and how much you'll hand over to the IRS for years after you leave work. Retire in January, and you could save thousands. Retire in November, and you might unknowingly trigger higher taxes, higher Medicare premiums, fewer tax-saving opportunities, and expensive financial mistakes that follow you long into retirement. The shocking part? Most people never realize any of this until it's already too late to change it. In today's video, I'll show you 5 powerful ways your retirement month affects your finances, from federal taxes and Roth conversions to Medicare premiums, health insurance costs, and capital gains taxes. By the end, you'll understand why changing your retirement date by just a few months can sometimes save $10,000, $15,000, or even $20,000 over the next several years. Before we begin, a quick disclaimer. This video is for educational purposes only and should not be considered legal, tax, or financial advice. Tax laws change, and every person's situation is different, so always consult a qualified tax professional before making important financial decisions. If you're new here, welcome. My name is Kevin, and every week I simplify retirement taxes, IRS rules, Medicare, and financial strategies into plain English, so you can protect more of the money you've spent a lifetime earning. If that sounds helpful, subscribe now and turn on notifications, because next week's video may save you even more than this one. Now let's start with the first timing mistake almost every future retiree overlooks. Most people spend months planning when to retire. They wait for the annual bonus. They wait for unused vacation days. They wait until one final project is finished. But almost nobody realizes that the month they choose to retire can quietly change their tax bill, not just for that year, but for several years afterward. The IRS doesn't care how many years you've worked. It doesn't care how loyal you've been to your employer. It only cares about one thing: which calendar year your income falls into. And that one detail can mean the difference between keeping thousands of dollars in your pocket or sending it straight to the government. For some retirees, choosing the wrong retirement month has cost $5,000, $10,000, even more than $20,000 over the next few years. Not because they made a bad investment, not because the market crashed, simply because they picked the wrong month to stop working. In today's video, I'll show you the 5 hidden ways your retirement month affects your finances, from your federal taxes and Medicare premiums to Roth conversions, health insurance costs, and even the capital gains taxes you may never see coming. Each one follows a different IRS rule. Each one uses a different timeline, and if you don't understand how they work together, you could accidentally pay thousands more than necessary without ever realizing why. Before we begin, a quick disclaimer. This video is for educational purposes only and should not be considered legal, tax, or financial advice. Tax laws change, and every person's situation is different, so always consult a qualified professional before making retirement or tax decisions. If you're new here, welcome. My name is Kevin, and every week I break down the tax rules, retirement strategies, and costly financial mistakes that most people discover only after it's too late. If you're over 60 or planning to retire in the next few years, this channel is built for you. So subscribe now, because next week's video may save you even more money before you receive your final paycheck. Now let me ask you something. Which month are you planning to retire? January? April? July? December? Write your answer in the comments below. I read every comment, and your answers help shape future videos. All right, let's begin with the first and perhaps the most overlooked reason your retirement month matters. Let's start with the first reason, and it's far more important than most people think. The month you retire directly affects how much federal income tax you'll owe for that year. At first glance, that sounds obvious. Work more months, earn more money, pay more tax. But that's only part of the story. The real issue isn't how much you earn, it's which tax bracket that income pushes you into. The IRS doesn't calculate taxes based on the day you retire. It looks at everything you earn between January 1st and December 31st and treats it as one tax year. That means someone who retires in January may spend almost the entire year in a lower tax bracket. Someone doing the exact same job, but retiring in November, could easily pay thousands more in taxes simply because they earned salary for most of the year. Here's a simple example. Imagine you're earning $120,000 per year. If you retire around the middle of the year, you'll receive only about half of that salary. After deductions, much of your income may remain inside a lower tax bracket, keeping your federal tax bill relatively small. Now compare that with retiring near the end of the year. Instead of 6 months of salary, you've earned almost the full year's income. Even if your tax rate doesn't jump dramatically, you'll likely owe several $1,000s more in federal income tax. Same employer, same annual salary, same retirement year. Only one thing changed: the month you chose to retire. And that's just the beginning. Because the extra salary doesn't only increase your income tax, it also affects almost every other retirement tax strategy you'll use later. Which brings us to the second and arguably the most valuable benefit of retiring earlier in the year: your Roth conversion opportunity. Now here's what most retirees never realize. The extra taxes you pay from working a few more months usually aren't the biggest financial mistake. In many cases, the real loss comes from the opportunities that disappear because your income stayed too high for too long. And nothing illustrates that better than what happens to your Roth conversion strategy. A single retirement date can determine whether you move tens of thousands of dollars into a tax-free Roth IRA at a low tax rate, or lose that opportunity forever. Let's look at why that happens. See you in next video.